Welcome to our webinar. Delighted to have you online and also delighted to be joined by our presenters today. So we have from Grunberg's Anelia, Sunil, Kalpesh and Nimesh. Welcome to you all. As the title suggests, this webinar is all about the highlights of last week's autumn statement and hopefully a bit more in-depth explanation of some of the points raised by the Chancellor in that budget. Although we're not allowed to call it a budget, are we? We have to call it the autumn statement. So a couple of housekeeping issues. We are recording this webinar, so we'll make a copy of the video available on our website tomorrow morning. We'll let you know by email that recording's available. And we will have time, hopefully at the end, for a live Q&A session. So if you have any questions, please use the Q&A function, which is one of the options on your Zoom toolbar. That allows us to see the questions coming through, and we'll try and get to those before the end of the session today. Hopefully that covers everything, and I'll hand over to Anelia at this point to take us forward.
Thank you, Jo. Good afternoon, and thank you for joining our webinar on the Chancellor Autumn Statement. As expected, the Autumn Statement 2022 has delivered many tax rises together with public spending cuts, which Chancellor consider essential to return the UK to fiscal stability. We'll go through some of the main changes, beginning with payroll and income tax. The Chancellor reduced the additional rate threshold from £150,000 to £125,000 per 140 from April 2023. This wasn't a surprise and means that those earning £150,000 or more will pay £1,243 more in taxes in 23-24 tax year comparing to 22-23 tax year. Higher income earners lose £1 for every £2 of income above £100,000 of their personal allowance already. And in addition, the difference between £150,000 and £125,140, which is £24,860 worth of income, will now fall into the additional rate tax bracket and tax at 45% instead of 40%. Furthermore, more self-employed individuals could potentially become additional rate taxpayers, paying 45% on earnings above £125,140. National insurance thresholds frozen. Before we consider the national insurance thresholds, we need to look back at the changes of national insurance rates. National insurance rules have changed 3 times during this year. In April 2022, the national insurance rate increased by 1.25% from 12% of earnings to 13.25% in April 2022. Earnings of above 50,270 per year were previously subject to national insurance deduction of 2%, but from 6th of April, this was increased to 3.25%. Employers' contribution also increased from 13.8% to 15.05%. From 6th of July 2022, the national insurance threshold, which is the level of earnings at which taxpayers have to start making contribution, became the same as the income tax threshold of £12,517. Prior to the increase, the threshold was £9,880. From 6th of November 2022, the plan increase of 1.25% was reversed, and taxpayers with earnings over the national insurance threshold of £12,570, so a reduction in the national insurance bill in November compared to July. This means that taxpayers will now enjoy national insurance tax cut, as the national insurance rate is now set back to 12% as opposed to 13.25%. And this was the second increase in national insurance payments following the increase in threshold in July 2022. The Chancellor also froze the level at which the employers start to pay Class 1 secondary national insurance for their employees at £9,100 until April 2022. This is likely to be the biggest cost for employers with rising wages. The additional national insurance due by employers is likely to be passed to consumers or result in reduction of employment. However, the government estimated that 40% of the employer will not be affected by fixing of the threshold because the national insurance bill will be covered by the employment allowance, which is currently set at £5,000. However, with wages continue to grow, the employees will notice the impact of the freeze of this threshold as well as employers, because more people will be pushed into the higher rate tax bracket. We'll now move to dividend allowance and capital gains annual exemption. The government is making these allowances less generous. The dividend tax allowance was introduced in 2016 at a rate of £5,000. The allowance will now be reduced to 10% of the original amount, £500 in 24-25. Originally in 2016, the introduction of the allowance meant that only people with significant dividend income will pay tax on dividends. With the reduction of these allowances from £2,000 to £1,000 in 2023-24, and then to £500 in 24-25, is likely to see that people with modest portfolios will pay more tax on dividend income in the future. Therefore, small business owners may want to consider bringing forward their increasing their dividends and paying larger dividends before 5th of April 2023 and reducing the dividends in subsequent years to a lower amount. Entrepreneurs, investors, and advisors were relieved that the rate of CGT was mentioned in the autumn statement. As CGT rates are higher than income tax rates, this can be seen as an easy target to raise tax. However, the Chancellor unexpectedly reduced the annual exempt amount from £12,300 to £6,000 in 23-24 tax year, and then further reduction to £3,000 in 24-25 tax year. This means that taxpayers selling residential property after 6th of April 2023 will pay £1,724 more in capital gains tax than in the previous year, and just over £1,200 if they sell any other assets compared to the previous year. While the reduction will only affect people that sell capital items and actually make profits, it means that will certainly increase the number of individuals brought into self-assessment. Currently, if you sell an asset and your capital gain is 12,300 or less, and the gross sales proceeds are no more than 4 times of the annual exemption amount, the disposal doesn't need to be reported to HMRC. However, the gross proceeds are now increased to £50,000, but with the reduced dividend, with the reduced capital annual exempt amount to £6,000, the reduction in the allowance means that more people will need to register for self-assessment and file tax returns. We're now moving to inheritance tax, and over to my colleague Sunil.
Thank you, Anelia. There hasn't been much change in the rates that are exempt from inheritance tax. The £325,000 rate, nil rate ban has been in force since 6th of April 2009. So you can imagine how long it's taken them for them to actually change anything on the rate bands. They then introduced the £175,000 residence nil rate band. So when you pass on your main residence to your direct descendants, then you are, in essence, passing across £500,000 of assets which are free of inheritance tax. Now, that reason for doing that was the government publicized a lot about having these rates, giving about £1 million, married couple giving £1 million assets to their descendants, and that was sort of a kind of a headline figure that they kept advertising in their manifesto. Now, what they have now done is these rates were supposed to have stayed on till 2026, and then they were going to be indexed. However, with the new budget proposals, they're going to be extended further. So they're going to last till April 2028 before anything is actually reviewed on whether they're going to be index linked and you're going to get further reliefs. And obviously, people will be looking towards getting lesser inheritance tax by actually planning for the future and by mitigating the inheritance tax. So people still have the usual exemptions. These have not been changed by the government. There was talk about getting rid of these exemptions, but they haven't touched them at all. So currently you can pass along £3,000 annually. If you haven't actually passed this along, then you can actually gift £6,000 in the year. You've also got gifting out of income, but there what you need to do is you have to write down your intention to make regular gifts and make those payments, and it should be look at income which is above all your expenses. Anything that is surplus income you can utilize and give away without any inheritance tax implications. Now, other thing that can be looked at is having a tax efficient will to ensure that you minimize your inheritance tax exposure when you actually pass away in the estate. The other one that usually IFAs are now getting well into is investing in unlisted companies, and when you survive 2 years, they are passed on free of tax using business relief. Now, there are also regular gifts that you can make. Gifts on marriage. If a parent was to give a gift, they can give away £5,000 without any inheritance tax. A remote ancestor, they can give out £2,500. Any other person is £1,000. All of these are kind of designed so that people are allowed to give away gifts which are reasonable, substantial, but without actually falling into their estate and creating an inheritance tax liability. There is also another exemption, which is small gifts, which you can pay £250 per person, but you've got to make sure that the same person doesn't in the same tax year have the same amount, because that would mean that basically some of the inheritance tax will fall back into the estate. I will now hand you over to Kalpesh, who will talk about research and development. Thank you.
Thank you, Sunil. So for companies, the main change has been in R&D. In the budget that was announced, the change was that for the SME relief, for small medium-sized entities, tax relief, the R&D tax relief changed from 130% to 86% from April 2023. This change basically, if I was to put it in an example, would mean that if you had £100,000 worth of expenses, qualifying R&D expenses, then you would get a deduction of an enhanced deduction of 130%, meaning you're getting a deduction of £230,000. However, the percentage change in April 2023 will mean that you're only getting £186,000 really for a £100,000 expenditure, which means a reduction in around £44,000. This, in essence, means that the profits for profit-making companies will increase, and for loss-making companies, the loss will reduce because the percentage is decreased. The other impact that this has is that the tax credit has also changed. The R&D tax credit has also gone down from 14% to 10%. That this tax credit can be claimed by loss-making companies. So if the company is making a loss, you can claim back tax for 14% of the loss currently, but now it's going to be 10%. So for companies that are new startups, companies that rely on the R&D tax credit, that relief, that rebate of tax that they're getting is going to reduce. Main planning point around this is that if there is any R&D expenditure that you are going to incur, that you can accelerate to the current year before the end of March, and then that would be a good idea, because that would allow you to claim either the tax relief at 130% or the tax credit at 14.5%. The other change is, like stated, is the RDEC changes. RDEC surprisingly is going up from 13% to 20%. Now, RDEC is claimed by small and medium-sized companies that can't claim or don't qualify for the R&D tax relief for SMEs, and claimed by large companies. Now, this is going up to 20%, so it will allow them to claim more relief, and it would bring the RDEC and R&D tax relief to more parity. Again, companies will want to assess, if you qualify for both, want to assess which tax relief gives you the better tax efficient, is more tax efficient for yourself. Next slide, please, Amelia. So this slide is just round up for the changes that have already happened. It's small companies with profits of up to £50,000. The corporation tax will be 19%. Companies with profits over £250,000 and over will pay corporation tax at 25%. So that's from April 2023. And again, planning point around here is, if there are any expenses that are not qualifying expenditure, you would ideally want to incur them after April, because it's giving you more tax relief, because if you're going to be paying tax at 25%. Again, the last point covers if you're paying tax between £50,000 and £250,000. Again, this is you'll pay tax on a sliding scale, and the tax will be between 19% and 25%. I'm going to hand you over back to Sunil now, who's going to take you through employee salaries and changes to salaries.
Right. The main aim for the government has been to try and increase the pay for individuals, and they're committed to having an ambitious plan to have 2/3 of the median earnings by 2024, and to reduce the age threshold to 21 years and over. So this year around, they've increased the national living wage by 9.7%. And all of these things means that employers have to plan for the future in terms of budgeting for these increases. And obviously, there will have to be consideration as to how best to actually minimize those taxes. And in that point, and now hand it over to Nimesh, who will be talking about how we can negate some of the impact of the budget.
Thank you, Sunil. So obviously, there's been quite a few changes, a lot of effective increases in tax that are coming in next year. It all seems as though it's doom and gloom, but we still go back to the general tax plan that we usually do for clients, and the items on your screen there, they always apply, and when taxes are going up, they become even more valuable. So the first way to mitigate these changes is to think about contributing to a pension, and it actually addresses most of these changes. So whether you're somebody who's going into the 45% tax bracket because your income is, say, 130,000 and the threshold is 125,140, or whether you're a limited company owner and you're going to suffer 25% corporation tax rather than 19%, or if you're an owner-managed business looking to take out dividends but are now concerned about the increased tax. If you're any of these individuals, then pensions are a really good way to offset these changes. Pension contributions made by individuals privately, they attract income tax relief. So what that means is, although there's increased tax for those that are earning more than 125,140, that can be offset against pension income tax relief. So you're not actually suffering from the changes. Just to give you an example, if your income is 130,000 and you're now in the 45% tax bracket, if you make a pension contribution, what that does, it extends your basic weight band. And what it means, it will take you longer to reach the 45% tax band. So contribution of almost £5,000 in this example would actually prevent you from going into the 45% band. And you'd also get income tax relief on the contributions. In terms of limited company owners that do not have large earnings personally, if their company makes a contribution to the directors or the employees' pension scheme, then the company can claim a deduction in their accounts, meaning they're getting 25% tax relief on the pension contribution, whereas before they're only getting 19%. So you can see how, although taxes are increasing, we could actually improve the benefits of certain forms of tax planning by taking advantage of the increases and getting more tax relief. And then also, if limited company owners have surplus profits, then rather than paying out more dividends and suffering more income tax, then perhaps they could look to contribute to pensions, set up an employer pension scheme, and actually reduce their corporation tax, and also reduce their income tax bill because they're not having to pay taxable dividends to themselves. So pensions is definitely an area where we can definitely benefit in terms of tax planning, and we can offset a lot of these changes. I haven't gone on to mention that the money that's in the pension fund can be invested in a tax-free environment, and also it can be sheltered from inheritance tax as well if it stays there. So it really is a lot of tax planning to be done with pensions, and when adverse changes come into fruition, then pension planning becomes more valuable. So that's definitely the first thing I thought of anyway. And if you are wanting to look at pension planning, it's always recommended to have a qualified pension advisor as well, to be working alongside ourselves. Second item on there is tax efficient remuneration. So looking at those individuals that are directors or employees, and obviously for the high earners, they're going into the 45% tax band earlier than usual. And those that are already in the 45% tax band are seeing more of their income taxed at 45%. So some of the things that we recommend to our clients are tax efficient share option schemes. So rather than just giving key staff salaries and bonuses, which are subject to increasing amounts of income tax and national insurance, perhaps you could offer employees equity in the business. It helps to incentivize these employees to help grow the business. So effectively, offering equity stake in the business could actually pay itself back if it incentivizes the employees to perform better. And then there's also tax efficient benefits in kind as well. So electric cars have become more popular over the last few years, and they are actually quite a tax efficient way to extract profits from the business. So if a company provides a car to an employee and it's fully electric, the company can claim a corporation tax deduction, and the benefit in kind to the employee is minimal at the moment. So rather than paying dividends out from the company and then using that money to buy an electric car, perhaps leave the money in the company and then instead use that to acquire an electric car. So you're actually not suffering a large amount of tax on the dividend income. It means you've actually got more money left to actually spend on the car. The next planning idea is charitable contributions. So when an individual makes a contribution to a charity that's registered in the UK or in the European Economic Area, then there's income tax relief they can claim. They can get the total tax relief they can get is actually equal to their marginal rate. So if you're a 45% taxpayer, you'll get 45% tax relief in total. If you're a high rate taxpayer, you'll get 40% in total. And if you're a basic rate taxpayer, you get 20% tax relief in total. And when we're seeing income tax increasing, then charitable contributions become more valuable. And also, you may actually be already contributing to charity and may not realise that the contributions may qualify for tax relief. So if you are contributing to a charity in the UK or in the European Economic Area, then you should speak to us. So we're actually making sure that you're getting the full tax relief on your contributions. The next item is tax efficient investments. And what I'm looking at here is whether individuals can consider investments in what we call the seed enterprise investment scheme and the enterprise investment scheme. These are investments in smaller companies, commonly startups, and also small established businesses of a certain size. What happens here is when you make an investment into one of these companies as an equity investment, then you actually get income tax relief at the time of making the investment. And you can get up to 50% tax relief on the investment if it's a company that qualifies for the seed enterprise investment scheme, and you can get up to 30% income tax relief if it's a company that qualifies for the enterprise investment scheme. So what's happening here is that you're making an investment that carries some risk, but the government is obviously helping you by giving you income tax relief at the beginning. So if you are going to make a loss, it's already partly set off by the income tax relief you've got when you acquire the shares. The other benefit of these tax efficient investments is that for the seed enterprise investment scheme, you can reduce your capital gains tax bill in the tax year of investment or the previous one. And for the enterprise investment scheme, you can actually defer capital gains until you sell the shares that you invested in. So if you make a capital gain, say today, you actually are able to invest into an enterprise investment scheme investment and not pay tax on that gain until the investment itself has been sold. The other major draw of these investments is that if you make a gain and you've held the shares for more than 3 years, the gain is exempt. If you make a loss, you have the option to offset the loss against your income. So once again, income tax rates or income tax bands are changing. So the ability to offset the loss against income could become more valuable. And the final thing that comes to mind is the savings allowance. So the dividend allowance is reducing. So it might be time for certain individuals with low amounts of income, but mainly investment income, to actually think, should you be investing in investments that give you interest income rather than dividend income? The reason being is the dividend allowance is on its way down to £500. The savings income, there's actually two allowances. You've got the starting rate, which is £5,000, well, maximum of £5,000. That applies to low earning individuals, mainly individuals that do not have any major income besides interest. They can get up to £5,000 of interest tax-free. And also you've got the an additional allowance of £1,000 tax-free interest income for basic rate taxpayers. It's £500 for a high rate taxpayer, but if you're in the additional rate tax band, you don't get this additional allowance for savings income. So when looking at whether you should switch to interest-bearing assets rather than dividend ones, then we're looking at individuals that are on a low amount of income. So for example, those that are retired and mainly have small amounts of investment income, they could perhaps look at their portfolios and see how they can rearrange them. So thank you for listening to us here. We'll be happy to take your questions. So we've actually got a few people here. We're happy to take your questions, whether it's on anything that's in these slides. If there's other things that you've thought about whilst reading these slides, then please feel free to ask those questions.
Okay, there is the first two questions here. The first question is, with the reduction of the 150,000 threshold, is it better to be self-employed or a limited company? Oh, that's a very good question, but there is no one solution that fits all. So the individual's personal circumstances will need to be considered. The reduction means that more income will be taxed at 45%. And therefore, if you have other sources of income, then you might as well consider incorporation. Incorporation also provides a certain level of protection, and also as the company is a separate entity to the individual, and also flexibility when you take money out of the company. Companies usually, you take money out of the company by way of salary and dividends, small salary and a dividend up to the basic rate tax band. However, if you require all your money to meet your living expenses, and that's in addition to the statutory financial obligation that the director of limited company has, then this may reduce the benefits of having a limited company. So the individual circumstances must be considered. And also before incorporation, you may want to consider pension contributions, charitable contribution, and other tax-efficient investments. Anyone would like to add anything, or we can just move to the next question?
Yeah, I'll just add something to that. So like Anelia said, everyone's circumstances are different. So what would be a useful exercise is to actually do a net pay comparison. So on one side of the calculation, you've got the scenario that the individual is self-employed. And on the right-hand side, you've got the scenario where they incorporate the business and are operating via a limited company. One of the things with the limited company is that obviously the company has to pay tax on the profits it makes, but the shareholder has the flexibility to reduce the dividend income, so they're not putting themselves in the additional rate threshold. So if you don't need all the profits to live off, you could actually set your dividend income so that it's not at a level where you're paying the additional rate for dividends, which at the moment it's 39.35%, so it's almost 40%. And also you can set the income level so that if it's possible, you can actually make it so it doesn't exceed 100,000. And the benefit of that is that you retain the personal allowance. So it is worth doing that exercise because limited company structures have more flexibility in terms of how you structure your personal tax. So it's definitely different for everyone. And it's a worthwhile exercise if you're impacted by these changes.
Okay, moving on to the next question. How do you minimize the impact of the reduction of capital gains tax annual exemption? Kapesh?
I can answer that. Yeah, the main planning point around here is to time your disposals. So currently the capital gains allowance is 12,300. So you would ideally want to utilize this allowance by the 5th of April 2023. So therefore, time your disposals sooner rather than later if you can dispose prior to April 2023. The other option, if you can't do that, would be, and the allowance goes down to 6,000 or 3,000. And the other option is if you own an asset, say a residential property, and you own it solely, and then potential spouse transfers could be an option. Transferring to the spouse and then disposing would allow you to claim 2 lots of capital gains allowances. You can claim and your spouse can claim as well. So that reduces the impact of any increasing taxes.
I would also like to point out it might be advisable in this day and age to try and use up the ISA allowances as well, because at the end of the day, all of those ISAs can grow free of both capital gains and income tax. So basically, those things don't have to even be reported on the tax return, and you could build up a portfolio by actually utilizing it on a yearly basis. So that's something people need to constructively look at in this day and age when all of these taxes are going up. So it's a good vehicle to look at.
Yeah, just to add to that, if you have assets that are making a loss, you may want to consider the timing of selling those as well. So if for some reason you can't sell certain assets before the exemptions go down, you may want to actually realise a loss on another asset so it offsets the gain, which might help you to mitigate the impacts of the annual exemption being so low compared to previous years. And the other thing that comes to mind is if you have assets that are owned in joint names, I think Kalpesh mentioned partners and spouses owning assets jointly. But if you have, say, 3 or 4 individuals that own an asset jointly, when that asset is sold, they could actually use the annual exemption 4 times in that scenario. When the annual exemption goes down, it's actually halving the annual exemption for all of these individuals, and if they're waiting too long, then it's going to make it a quarter for each individual. So what I'm saying is that when you've got assets that are jointly held between lots of people, by waiting to make the sale, you're wasting a lot of annual exemptions that are available now, because it's actually each individual joint owner that's suffering the reduced allowance each. So if you do have assets that are held in many individuals' names, then and you're looking to sell those assets, you may want to try and complete those sales this tax year. Could actually save quite a lot of tax between everyone.
And maybe just to mention that transfer of assets between spouses is at new gain, new loss. So if one of the spouses is a higher rate taxpayer or additional rate taxpayer, and the other is basic rate taxpayer, it's for transferring assets between them earlier rather than later. There is no loss, no gain on that transfer. So if we don't have any more questions, I think we'll be ready to end the webinar. And these are our contact details. If you require any advice or would like us to consider your personal circumstances and how these changes will affect you, please contact us.